Hello and welcome back to Investing for Generations, your channel for high quality stock research for long-term value investor. And today I want to continue my analysis of 5 undervalued businesses, and today we have part 3. And today I want to talk about a company out of a sector not very sexy, a little bit macabre maybe, is on the funeral sector. And the company I want to talk about is a Service Corporation International. Service Corporation International is traded right now at $47 with a market capitalization of 8 billion, a PE ratio of 16 and a forward dividend yield of 1.76%. And the Service Corporation International is North America's largest provider of funeral and cemetery services. They was founded in 1962 and is headquartered in Houston, Texas. They currently own and operate more than 1,900 funeral homes and cemeteries in 44 states, 8 Canadian provinces, the District of Columbia, and Puerto Rico. And with that, they are the largest North American death care company, with a market share of 15 to 16%, which is way more than the second best. So they are the market leader in North America in this sector. And then when we look at the stock price over the last 5 years, then we see a slow but steady growing, up and up and up. And then of course last year March it dropped like everything else in the market, and then just rose again to in the top $57, which was a gain of 125% over the last 5 years. And then just lately it dropped down 12% to now currently $47. And the question is this a good business? Is this a growing business in the future? Are these prices maybe good prices to buy into this company? And therefore, as always, I go to macrotrends.net, where you find all the data for almost every business, and start to analyze the financial numbers of Service Corporation International. And starting with the revenue, and the revenue over the last 5 years just grew from $2.98 billion to now $3.5 billion. This is a slow but steady growing. And also when we look at the earnings per share, then we see also here it grew from $1.14 over the last 5 years to lately $2.88. When we look at the margins, then we see that they work right now at a net margin of 14%, which is nice, and over the last few years it was around 15% all the time, which is a nice net margin. Also, the return on equity with almost 30% is good. This is a good number. The return on investments with 9.73% could be a little bit higher. I like it more between 12 and 15%, but overall it's okay. And what I really like, they were able to grow their free cash flow over the last 5 years to now $3.37 per share. And this is very good. I like when the free cash flow just grow and grow and grow, and this looks really, really good. And then also take a look at the balance sheet, and here we see that they have a long-term debt of $3.51 billion compared to a shareholder equity of $1.75 billion, which become a debt to equity ratio of 2.01. This is a little bit high. Normally I like my businesses with a debt equity ratio under 1. So it's a little bit too high for me to be perfect, but I think it's not a big issue. I think they were even able to reduce their debt equity ratio because they just grow their shareholder equity, and so the direction is right. So it's not perfect, but it's not a big issue. And so overall we have very nice numbers here. Very stable company. I really like that. And I really like the business. First of all, I like the business because it's recession proofed. There will be deaths all the time, and when you look at the statistics, then you see that the deaths, just because of the birth generations, just will grow over time, and there will be more deaths in the future. And so also you can expect that the business of Service Corporation will grow, not fast but steady. And then they also expect an annual growth rate of 8 to 12% per year on the EPS, and this is a good number to calculate later the intrinsic value. And so overall we have a good company, a very stable, very profitable company, so high quality with high free cash flows. Only negative is the debt equity ratio, which is a little bit too high but not a big issue. And overall also in a growing market, in a slow but steady growing market. Overall, all of these parameters are very, very good. But then of course we come back to Warren Buffett, who said price is what you pay, value is what you get. And so of course you need high quality value in the company, but on the other hand you have to buy for the right price. And to know what's the right price and what is a good price to pay, you have to calculate the intrinsic value. And therefore I go once again to the Excel sheet of Sven Carlin. I put a link down in the description where you can download this for free. If you're new to my channel, you maybe never saw that before. Here you just can calculate the intrinsic value of every business. And I like to do this as simple as possible with the earnings per share. And the earnings per share for Service Corporation in the last 12 months was $2.88. And then we saw before the growth rate, the estimated growth rate is between 8 and 12% per year. And to be a little bit conservative, I just picked the middle to calculate. So I calculate with 10% for the next 5 years, and then maybe a little bit of slow down to 7%. This is very conservative. If you remember the chart before with the deaths, maybe it could be even, the growth rate could be even higher in the future. But let's be conservative, so put there 7% for the years 5 to 10. And then you also need a discount rate, and my discount rate or my expected return for almost every investment in the stock market is 12%. And then we also need a terminal multiply, and I take for the terminal multiply the historical average of the PE ratio. And for Service Corporation we come here with 18. This is also kind of conservative. And when we put this together, then we come to an intrinsic value of $60. And then of course you can do the same thing with the best case scenario when you go up to the higher estimated growth rates and the higher PE ratio, terminal multiply, or even with a worst case when you go and calculate with lower growth rates. And of course when the growth rates are lower, like 5%, and maybe terminal multiply is also very low, then of course the present value is just $32 per share. And so you have to keep all of that in mind just to see the upside but also the downside, of course, because as with every investment, some of them just will not work, but with this calculation at least you have an idea also of the downside. But then when you put in the probability of all these scenarios and say the normal case scenario, which is the first one, is maybe happen 60% of the time, and then 20% for the best and worst case scenario, then you come to an intrinsic value of $57, let's say around $60. And so at the end we have an intrinsic value of around $60, which is compared to the current stock price of $47, just mean that Service Corporation is undervalued right now. Not highly undervalued, but quite a bit. And it's a really interesting business. If you follow me for a while, you should know that I like boring businesses. And what could be more boring than that? And so I really think about to take a position, maybe not a big one, but just take one to have skin in the game. We will see how this will work out. At least it's very high on my watch list. And of course it's very difficult in these times, in a still way overvalued market, to find good businesses undervalued, and maybe here with Service Corporation we found one. So that's it for today. If you like the video, please subscribe to my channel, and then in the next few days I will come up with the fourth part of my 5 undervalued businesses. And of course you find also the other 2 videos here on my channel, and you also find an insight to my real money portfolio on my channel. I give you an update every week on that. So if you like the whole idea of the long-term value investment, just subscribe, ring the notification bell, and you will never miss another video. See you then. Take care. Bye bye.